Today, the 3% serviceability buffer remains. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and broad news with a distinctively Australian flavour. Well, there's been some speculation that with the higher interest rates, maybe APRA will be considering trimming the 3% serviceability buffer. This, of course, is above the current mortgage rate on offer, and it's the rate at which banks consider how households can service their mortgages. So as it goes up, so mortgages become less affordable. Anyway, today APRA has announced that the 3% serviceability buffer for home loans is going to remain in place, saying that the potential for future interest rate rises, high inflation and risks in the labour market make this appropriate. So the Australian Prudential Regulatory Authority published an update on its macroprudential policy settings, explaining the key factors that have informed the current levels. It said that the information paper provided greater transparency on macroprudential policy in line with APRA's new framework, which was published back in 2021. APRA said macroprudential policy was an important feature of its toolkit, and it involves policy measures aimed at promoting stability at a systemic level. In the information paper, APRA confirmed its view that existing policy settings remain appropriate based on the current risk outlook. And overall, that means that there is a neutral level for the countercyclical capital buffer of 1% of risk-weighted assets, providing a buffer in bank capital for stress if needed, and also a 3% serviceability buffer to maintain prudent lending standards. It's very interesting that the countercyclical buffer wasn't, of course, in place when interest rates were ultra low, which in retrospect was probably a mistake. The APRA chair, John Lonsdale, said that the settings remained appropriate given the potential for domestic and global economic conditions to deteriorate. APRA closely monitors financial risks, and we see a high degree of uncertainty in the broader outlook, globally and domestically, Lonsdale said. On one hand, there are signs of a deterioration in conditions, including falling asset prices and the potential for pockets of stress. On the other hand, lending standards are broadly sound, loan arrears remain low, and the banking system is well capitalised. On that basis, we believe our current macroprudential policy settings remain appropriate, and in particular APRA's view is that the 3% level remains prudent given the potential for further interest rate rises, high inflation and risks in the labour market. Although Lonsdale did say that those settings were not necessarily set in stone. The events of recent years have emphasised that conditions may change rapidly, he said. We continue to closely monitor the outlook for credit growth, asset prices, lending conditions and financial resilience. And Lonsdale said, should risks to financial stability change, APRA would adjust its macroprudential policy settings accordingly after careful consideration and consultation with other agencies on the Council of Financial Regulators, which of course is the entity driven and run by the RBA. So in a way, I think this is actually good news because it means that we're not going to see regulators trying to prop up the property market artificially even more than they have been. And it must be said, bearing in mind that the average long-term interest rate is around 7%, that the serviceability buffer, which will be closer to 10%, would actually be quite a significant break on future lending. And as I remind you, and remind you again, the truth is that the bulk of home prices are stoked by ultra-cheap capital and ultra-free lending, which means the reverse is also true. As interest rates rise, as the serviceability buffer increases the real rate to real households, it means that property prices are going to head downwards rather than up. And I don't think that we're going to see a change in trajectory in home prices for quite some time. It could be a 3 to 5 year cycle, but we'll know more in the months ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.